What if everything you've been taught about economic growth is wrong? What if progress, rising GDP, and expanding prosperity don't come from innovation or productivity alone, but from something far more uncomfortable? What if the global economy only functions because debt is never truly repaid? From childhood, we're taught a simple rule: borrowing is dangerous. Debt should be minimized, and financial responsibility means paying what you owe as quickly as possible. But if that rule were applied to nations, corporations, and the global financial system, modern civilization would collapse almost overnight. That is the mystery. If debt is risky, if debt is morally condemned, if debt is mathematically impossible to repay at a global scale, then why does the entire economic system depend on it? And why does growth vanish the moment debt stops expanding? Welcome to its financial history too. To answer that, we need to go back not to Wall Street or central banks, but to the origins of debt itself. Debt didn't begin as a financial instrument. It began as a social obligation. In the earliest civilizations, debt was personal, physical, and unforgiving. In ancient Mesopotamia, farmers borrowed seeds and tools from temples and palaces. If crops failed, debts were not written off. People were. Families were enslaved, land was seized, and social stability eroded. Rulers quickly learned a brutal lesson: when debts grow faster than people's ability to pay, society breaks. That's why many ancient kings periodically declared debt jubilees, mass cancellations of obligations. Not out of mercy, but survival. Without resets, economies imploded under their own weight. Rome faced repeated debt crises that fueled revolts and political violence. Medieval Europe tied generations of peasants to land through inherited obligations. In China, entire dynasties fell when fiscal burdens became unmanageable. Across cultures and centuries, the pattern was the same. Debt accumulates, repayment becomes impossible, collapse follows. Modern economics didn't escape this cycle. It simply hid it. The true transformation happened when money itself became debt. Under gold-backed systems, lending was constrained. You could only loan what physically existed. Growth was slow, limited by real resources. That limitation frustrated bankers and governments alike. Then came fractional reserve banking, one of the most powerful inventions in economic history. Banks realized they didn't need to lend actual money. They only needed to create promises. A loan didn't transfer existing wealth. It created new money backed by the borrower's future labor. This unlocked explosive growth. Economies could now expand faster than their physical limits. Infrastructure boomed. Trade accelerated. Industrialization surged. But hidden inside this miracle was a fatal contradiction. Every loan creates principal plus interest, but only the principal is created as money. The interest is not. So where does the extra money come from? It can only come from new loans. Debt doesn't get resolved. It gets rolled forward. This wasn't a mistake. It was the engine. As capitalism matured, debt became inseparable from progress. Railroads were built on credit. Corporations expanded through leverage. Governments borrowed to fight wars, then borrowed again to rebuild. Economic growth became less about producing more and more about borrowing more. The 20th century locked this system into place. After the Great Depression, governments learned that when growth slows, borrowing accelerates recovery. Deficits became tools, not emergencies. What began as temporary measures hardened into permanent policy. Then came the final break in 1971, when money was untethered from gold entirely. With no physical constraint, debt could grow infinitely. And so could GDP, at least statistically. This is where the illusion deepened. If every household tried to pay off its debt at once, the economy would contract sharply. But if every government and corporation tried to do the same, the global system would collapse. Because paying back debt destroys money. When loans are repaid, money disappears from circulation. Less money means less spending. Less spending means layoffs. Layoffs cause defaults. Defaults destabilize banks. Banks stop lending, and growth dies, so the system doesn't reward repayment. It punishes it. That's why governments refinance instead of retiring debt. Corporations issue new bonds to pay old ones. Consumers rely on credit to maintain living standards as wages stagnate. Debt is never meant to end. It is meant to expand forever. When it can't, crises erupt. Every major financial collapse follows this script. In 1929, debt fueled speculation met contraction. Credit dried up, and the Great Depression followed. In 2008, mortgage debt expanded faster than incomes. When borrowers defaulted, the system froze. The response wasn't repayment, it was trillions in new debt to prevent collapse. During the COVID era, shutdowns threatened mass defaults across the economy. Governments responded with unprecedented borrowing. Debt exploded, but collapse was postponed. Each time, the solution is identical. Use more debt to fix the damage caused by too much debt. And each time, the system becomes more fragile. Policymakers are not blind to this. They've tried to escape the trap. But every attempted solution carries its own disaster. Austerity slows growth and increases default risk. Raising interest rates exposes debts that were never sustainable. Debt forgiveness destabilizes political trust and financial systems. Inflation quietly erodes obligations but destroys purchasing power and social stability. So instead of solving the problem, the system delays it. Central banks suppress interest rates. Governments normalize deficits. Asset prices inflate to disguise stagnation in real productivity. Growth continues, but it becomes thinner, more unequal, and more dependent on leverage. Today, global debt exceeds 3 times the size of the world economy. Even if every dollar of output went toward repayment, it wouldn't be enough. Productivity growth is slowing. Wages lag behind inflation. Younger generations inherit obligations they never agreed to, while markets demand endless expansion. This is not new. It is the same pattern seen across history, just scaled globally. And that leads to the uncomfortable truth. Economic growth exists because debt is never fully repaid and never can be. Debt is not a temporary distortion of capitalism. It is its foundation. Growth doesn't eliminate debt. Debt creates growth. And the moment growth slows, the system begins to fracture. Crises aren't anomalies. They are pressure releases. They are what happens when the math finally overwhelms the narrative. So what does this mean? First, debt is not primarily a moral failure. It is a structural necessity of the modern system. Borrowers are not bugs. They are the fuel. Second, economic crashes are not random accidents. They are resets. Moments when unpayable obligations collide with reality. Third, the future is not about whether this system changes, but how. Through inflation, restructuring, technological transformation, or something entirely new. But not through repayment. History is clear on one point. When debt grows faster than reality, reality always wins. The only question left is timing. If this made you question how growth really works and what's holding it together, subscribe for more deep explorations into the hidden mechanics of money, power, and history. Because the most dangerous assumptions are the ones everyone accepts without question.